Ever find yourself, wondering just how these big pharma companies are able to, well, stay so adaptable in this like crazy fast-changing world of medicine?
Right. It's fascinating.
It really is. And that's exactly what we're diving into today. Some seriously strategic moves by Sanofi, specifically over in India. We've been poring over this recent article, and, well, it's got some pretty interesting insights into how they're shifting gears, and what that might mean for how we access everyday medicines, not just in India, but, potentially everywhere.
Definitely. It's a bit of a global story.
Totally.
Yeah.
But we're zeroing in on Sanofi's activities in India.
Exactly. We're particularly interested in their focus on the consumer healthcare side of things, how they're really leaning into that.
Right, right. And this article breaks down their financials, their decision-making, all within the context of the Indian market.
It's like a case study almost.
It is. So our mission, if you will, is to understand, why a major pharmaceutical player like Sanofi is starting to look and act a lot more like, well, a fast-moving consumer goods company. We're talking FMCG.
The world of, your everyday products, your snacks, your personal care items.
Yeah, exactly, that kind of thing. So the big question is, what's driving this? And what does it tell us about where the whole industry might be headed? Because, it's pretty big.
Huge.
Huge. And it affects all of us in some way, So let's get into it. This article throws out a pretty eye-opening number right off the bat. In 2024, Sanofi pulled in a cool Rs 240 crore, that's like $27.5 million in U.S. currency in dividends from its operations in India, and that includes their newly independent consumer health arm.
It's pretty significant.
It is. I mean, even with some of the challenges they've been facing on the core pharmaceutical side, they're still leveraging the consumer arm to deliver some, immediate value back to the main company.
That's smart business.
Super smart. Now, here's where it gets interesting. The article points out that while those dividends are rolling in, Sanofi India's core pharmaceutical business actually took a bit of a hit. They saw a 14% drop in profit, ending up at Rs 314 crore for 2024.
And this was also the same year they spun off their consumer healthcare arm. They actually listed Sanofi Consumer Healthcare separately on the Indian stock market.
Exactly. So we see the traditional prescription drug business facing some headwinds, right?
Definitely.
But it seems like the consumer healthcare division is, well, stepping up to the plate. The article even uses the phrase picking up some of the slack, which I thought was interesting.
They are, and they're doing it in a pretty strategic way.
For sure. And the article points out that both divisions, both the consumer healthcare and the pharma, declared some pretty hefty per-share dividends. Consumer healthcare at Rs 55 and pharma at Rs 117. And, since Sanofi, the global parent company, owns a majority stake in both, that money essentially flows right back to them.
Right.
So even though the core pharma business dipped a bit, the consumer health arm is helping to soften that blow. I mean, it's a pretty clear sign that consumer healthcare is playing an increasingly important role for Sanofi, at least when we look at their bottom line in India.
Definitely. And if we zoom out a bit, by the first quarter of 2024, Sanofi Consumer Healthcare was already a major player in the parent company's overall performance. It was like a powerhouse. We're talking 30% of Sanofi SA's total sales and something like 40% of its operating profit.
Those are huge numbers.
They are. They really underscore just how significant this shift has been, don't they?
They really do. And it's interesting because it's not just about like short-term financial wins, The article really emphasizes that this is a fundamental strategic move by Sanofi. And the main reason behind it, it seems, is that traditional pharmaceutical business is, well, it's a tough game. It's slow-moving, heavily regulated, and there's this whole, complex web of approvals and compliance that they have to deal with. Consumer healthcare, on the other hand, is more nimble, it's faster paced, and it just doesn't have the same level of regulatory hurdles.
Right. It's a whole different ballgame.
It is. And of course, the profit margins are generally a lot better on the consumer healthcare side, too. So when you look at it that way, it's not hard to see why Sanofi is making this shift.
It's all about recognizing, where the opportunities lie.
Yeah.
And the article highlights a really interesting way that Sanofi internally describes this strategic change. They call it FMCH, or Fast-Moving Consumer Healthcare, FMCH. They're basically like taking the playbook from traditional FMCG companies, the ones that market, your everyday products. Think about how they sell those products and applying that to over-the-counter healthcare.
It's like they're saying, hey, if it works for toothpaste and potato chips, why not cough syrup and pain reliever?
Exactly. And think about what this means for the average person, Your medication's being marketed with the same techniques as, like, your favorite cereal or your go-to cleaning supplies. It's a big shift in how we think about health and wellness.
It really is. And Sanofi's not alone in this. The article actually brings up Zydus Life Sciences as an example. They made a similar move way back in 2008, setting up Zydus Wellness, which is the company behind brands like Sugar Free and Glucon D. And, that's been a pretty successful move for them.
Oh, definitely. Consumer health now makes up almost a quarter of Zydus's revenue in India.
It's amazing. Last fiscal year, Zydus Wellness raked in over 6,000 crore. They saw like a 10% year-on-year growth in the last quarter alone. So, it's clearly a strategy that's paying off.
Yeah, it's not just a fluke. And, we're seeing other major players in the pharma world following suit.
Oh, yeah, for sure.
GSK, for example, they spun off their consumer arm, Haleon, back in 2019. That's where you've got brands like Sensodyne and Strepsils. And then there's Johnson & Johnson. They did the same in 2021, creating Kenvue, which houses those iconic brands like Band-Aid and Tylenol.
It's a trend.
It really is. It seems like a lot of these companies are recognizing that there's a ton of value in having a dedicated consumer healthcare business. In fact, Rodolfo Froese, the MD of Sanofi India, actually talked about this back in May 2023 when they announced their demerger. He was basically echoing this sentiment, saying that they're aligning themselves with these broader industry trends.
Now, here's what's particularly interesting about Sanofi's approach. Unlike Zydus, which has maintained a pretty clear separation between their pharma and consumer health divisions, Sanofi seems to be, intentionally blurring the lines a bit. They're reclassifying and marketing certain pharmaceutical products as consumer care items.
That's an interesting strategy.
It is, and it's working. Take Allegra, for example. It's still a highly effective antihistamine, but it's now available over the counter and being positioned more as a general wellness product, something you can just pick up at the store.
Like a vitamin almost.
Yeah, exactly. And what's interesting? This shift is happening even though the broader FMCG sector in India hasn't been doing as well as healthcare overall. While your everyday consumer goods companies are seeing slower growth, the healthcare sector, which includes both pharma and consumer health, has been performing really strongly, especially on the Indian stock market.
It's a good sign for investors.
Right. It's like investors are seeing more potential for growth in healthcare, even when you compare it to those big established FMCG players. And in fact, if you look at the performance of the BSE Healthcare Index versus the BSE FMCG Index, the healthcare index has completely outperformed the FMCG index over the past couple of years. So that's something to think about.
Definitely. I mean, the numbers speak for themselves.
They do. It's almost like there's this unspoken sentiment of pharma is hard, FMCG is easier. And that's playing out in their marketing strategies, too. Recently, Sanofi India hired FCB India to promote their laxative brand, Dulcoflex. And traditional pharma companies, they have all these restrictions on how they can advertise prescription meds, right? But when it comes to OTC products like laxatives, well, they have a lot more freedom. They can use a lot of those classic FMCG marketing tactics, even things like celebrity endorsements and social media campaigns.
A whole different world.
It is. And, this trend isn't limited to just India.
No, not at all.
Sanofi SA's global consumer division, Opella, is even exploring the possibility of making Cialis, a drug for erectile dysfunction, available over the counter in the U.S. They've already started FDA trials for it.
Wow.
So we might be seeing a future where certain medications become much easier to access.
Potentially.
Yeah.
But it's worth noting that the regulatory landscape in India is still, in flux when it comes to this kind of thing.
It is. The government only started reviewing which prescription drugs could potentially become OTC back in May 2024. And we're still waiting on the panel's report.
Right.
So it's kind of like Sanofi's walking this tightrope, carefully reclassifying existing medications where they can, like with Allegra, but also, being patient and waiting for broader regulatory changes that could really open things up.
It's a delicate balance.
For sure. And let's not forget the financial motivation here.
Right. I mean, money talks.
It does. And Sanofi India's CFO, Vaibhav Karendikar, he's been pretty open about the fact that consumer healthcare just offers a better margin profile. We're talking 8 to 10% higher than their blended margins of, around 25-26%.
That's significant.
Huge. And when you ask analysts why, they point to the fact that, fewer regulations equals lower costs, right? And then selling directly to consumers cuts out some of those middlemen in the traditional prescription drug supply chain. So they're basically making more profit on each sale of a consumer health product compared to a prescription drug, in part because they don't have that same level of oversight and associated costs.
Right. It makes sense.
Totally. And Trisha Wagela, an equity research analyst, she goes even further. She points out that by focusing on consumer healthcare, companies can reduce their reliance on medical representatives and all of those interactions with healthcare professionals that are usually needed to promote prescription drugs.
So they're cutting out a whole layer of expense.
Exactly. It leads to lower overhead costs and gives them more flexibility to do those, direct consumer marketing campaigns.
It's all about streamlining.
It is.
Yeah.
And Jay Doshi, he's a pharma professional, he also weighed in. He basically said that having a separate consumer healthcare arm can really lighten the overall compliance burden for the bigger pharmaceutical company. And it also makes them more attractive to investors because, as we discussed earlier, there's just less red tape when it comes to marketing and promotion in the consumer health world.
Makes sense.
Right. So all of that is contributing to this shift. Now, let's talk about some specific brands, because Sanofi has some real heavy hitters in their consumer healthcare portfolio. I mean, we're talking about those brands that people know and love, the ones they actually go looking for. Allegra, for example, which went from prescription only to over-the-counter back in 2011, now has a whopping 80% market share in the respiratory category.
That's huge.
Huge. And Comiflam, their pain reliever, well, they've got like 55% of the analgesics market.
They're dominating.
Totally. And Himanshu Bakshi, he's the MD of Sanofi Consumer Healthcare India. He also highlighted brands like Avil, Depura, and Dulcoflex as being like major players for them. And if you look at the numbers, the growth rates in the first quarter of the last fiscal year were really impressive. Their allergy, wellness, and pain care segments were all significantly outperforming their general medicine business. It's pretty clear where the momentum is.
It is. And, we've seen other companies successfully transition their prescription drugs to OTC in India.
Oh, yeah.
Like, think about Crocin from GSK, Volini from Sun Pharma, and Softovac from Lupin. They've all made that move.
Right. So it's definitely a viable strategy. And from an operational standpoint, there are some definite advantages to having a separate consumer health division. Sanofi India's general medicine manufacturing, it involves their own facility in Goa and then some work with contract manufacturers. But by spinning off the consumer division, they can really fine-tune their manufacturing processes for OTC products.
Right, and that could lead to even more cost saving.
Exactly. It's all about optimization, right?
Yep. Efficiency.
And then there's the Indian OTC market itself. I mean, it's enormous. In 2024, it was valued at a staggering $245 billion, and it grew by 14% in 2023 alone. So it's no wonder that Sanofi wants a bigger piece of that pie.
I mean, who wouldn't?
Right. And Rodolfo Rose, he actually believes that there's huge potential for more prescription to OTC transitions in India. He sees it as a major avenue for growth.
It makes sense.
It does. Now, here's another really interesting aspect of this whole consumer health focus.
Yeah.
Data.
Data, yes. Data is gold.
It is. By engaging directly with consumers, companies like Sanofi gain access to all sorts of valuable information about, consumer preferences and buying behaviors. It's incredibly valuable. And Himanshu Bakshi has talked about how they can leverage global consumer health data and their digital capabilities to drive organic growth and, really get those direct-to-consumer brand activations going. He specifically mentioned e-commerce as being a key part of this.
E-commerce is huge, right? It's changing everything. And Zydus Wellness, they're also paying close attention to these changing consumer behaviors. Tarun Arora, their CEO, he recently pointed out that there's this growing demand for smaller, single-use packaging, so they're having to adjust their product strategy and pricing accordingly.
Interesting.
It is. I mean,
Yeah.
even if it potentially means a slightly lower profit margin per unit.
Right. But it's about meeting the consumer where they are.
Exactly. It's about adapting. And, it's interesting to compare Sanofi's approach, which is more about transforming existing prescription drugs, with Zydus's strategy, which has involved some pretty big acquisitions to broaden their consumer health portfolio. Like they bought Kraft Heinz India back in 2018 and then Natural India more recently.
It's two different paths to the same destination.
Exactly. And India is a really important market in all of this. It's the 6th largest consumer healthcare market globally and the 10th largest for Sanofi's consumer brands specifically. Right. So you can see why they're investing so heavily there. And it seems like the next frontier for them is distribution. Right now, most of their OTC products are sold in, regular retail pharmacies and online pharmacies. Right. But the trend is definitely moving towards broader distribution. Think grocery stores, other e-commerce platforms, making those products even more accessible.
It's about convenience.
Convenience, absolutely. And finally, if we look at it from an investor's perspective, these consumer health spin-offs are generally seen as a good thing. They tend to trade at higher valuations compared to their parent pharma companies. The article actually gave some examples, like as of March 6, 2025, Sanofi Consumer Healthcare had a price-to-earnings ratio of 55x, while Sanofi India was at 34x, and then Zydus Wellness was at 32x, while Zydus Life Sciences was at 20.5x.
So the market is rewarding these consumer-focused companies.
It seems that way, and it's all driven by those factors we talked about earlier. Less stringent regulations, the potential for better margins, and just overall positive sentiment about the consumer healthcare sector.
Right, right.
So, to sum it all up, Sanofi's move towards consumer healthcare in India, it's not just some random event. It's actually part of a much larger trend that's playing out across the entire pharmaceutical industry. And at its core, this shift is driven by, well, financial incentives. The consumer healthcare sector just offers a lot more potential for profit. And there's also this growing desire among these companies to connect directly with the people who use their products, to build those relationships.
And that's a powerful thing.
It is. It's about more than just selling pills. It's about, becoming a part of people's everyday lives. And that brings us to, I think, a really interesting question. As regulations potentially change and more prescription drugs become available over the counter, how will that affect how you think about your own health? How will it change your approach to managing your well-being? It's something to ponder.
Definitely. It's a whole new world of healthcare that's emerging.
It is. The line between what's a pharmaceutical product and what's an everyday consumer good is getting blurrier and blurrier. And what Sanofi's doing in India, it's a really fascinating glimpse into how that landscape is evolving. Thanks for joining us on this deep dive.
It's been a pleasure.
Until next time.
See you then.